Why do most traders fail? It's not because their indicators don't work. It's because they either use way too many of them, or they use them completely the wrong way. In this video, I'm going to break down 10 powerful trading indicators, and, more importantly, I'll show you how consistently profitable traders actually use them in the real world. Forget the textbook definitions. This is what actually works. First up, the exponential moving averages, or EM. We'll focus on the 9 and 21 periods. These lines are fantastic for identifying the direction of the trend. When the price stays consistently above both the 9 and 21 EMA, the market is in a clear uptrend or bullish. Conversely, when the price stays below them, the market is in a downtrend or bearish. Here is the key. Profitable traders don't use EMA crossovers as simple buy or sell signals. That's a recipe for getting chopped up. Instead, they use EMAs as a trend filter. If the price is above the EMAs, they only look for buying opportunities. If it's below, they only consider selling. It simplifies decision-making and keeps them on the right side of the market. Next, we have the Relative Strength Index, or RSI. Most people are taught to sell when the RSI is overbought, above 70, and buy when it's oversold, below 30. Profitable traders rarely do this. Why? Because in a strong trend, the RSI can stay overbought or oversold for a very long time. Instead, they look for something far more powerful, RSI divergence. This occurs when the price makes a new high, but the RSI makes a lower high. This is called bearish divergence, and it signals that the upward momentum is weakening, hinting at a potential reversal. The same concept applies in reverse for bullish divergence, when price makes a new low but the RSI makes a higher low. Divergence gives you a heads up that the current trend might be running out of steam. Let's talk about the MACD, which stands for Moving Average Convergence Divergence. This indicator is great for identifying shifts in momentum. While many focused on the MACD line crossovers, smart traders pay close attention to the histogram visually represents the distance between the two MACD lines. When the market has been consolidating or moving sideways, the histogram will be very small, hugging the zero line. The real signal comes when the histogram starts to expand and grow larger after this period of consolidation. A rapidly expanding histogram often signals the beginning of a strong, impulsive move in that direction, giving you an early entry into a new burst of momentum. Now for an indicator that many beginners ignore. Volume. Volume shows you the conviction behind a price move. It tells you how many traders are participating. Think of it as the fuel for the market's engine. A breakout from a key level on high. Explosive volume is much more likely to be successful and continue in that direction. On the other hand, if you see a breakout on very low or declining volume, be cautious. It's often a fake out, a trap designed to lure in unsuspecting traders before the price reverses. Always check for volume confirmation on your key breakouts. Let's move on to the VWAP, or Volume Weighted Average Price. This is a favorite among institutional traders. The VWAP represents the average price that an asset is traded at throughout the day, weighted by volume. It essentially shows you the fair price based on actual trading activity. The rule is simple. When the price is trading above the VWAP, buyers are in control, and it acts as a dynamic level of support. When the price is trading below the VWAP, sellers are in control, and it acts as dynamic resistance. Institutions often use VWAP to execute large orders, so paying attention to how price reacts around this level can give you a significant edge. Next are Bollinger Bands. These bands measure volatility. They consist of a middle band, which is a simple moving average, and two outer bands that represent standard deviations away from the middle line. Many traders try to trade bounces off the bands, but the real power lies in the squeeze. A Bollinger Band squeeze happens when the bands come very close together, signaling a period of extremely low volatility. Low volatility is almost always followed by high volatility. When the price breaks out of this squeeze with force, it often leads to an explosive and sustained move. The squeeze is your signal to get ready for a big play. Now, let's discuss Fibonacci Retracement. This tool helps identify potential support and resistance levels where price pullback might end. After a strong move up or down, The price will often retrace a portion of that move before continuing in the original direction. Profitable traders draw the Fibonacci tool from the start to the end of the move and pay close attention to the 0.5 and the 0.618 levels. These are known as the golden pocket because price has a high probability of reacting in this zone. Traders watch for price to pull back to this area and show signs of a bounce before entering in the direction of the primary trend. Let's look at the ATR, or average true range. This is a pure volatility indicator. It tells you nothing about price direction. So what's it for? Risk management. The ATR tells you the average range an asset has moved over a certain period. Profitable traders use this to set realistic stop losses. For example, if the ATR is 10 points, placing a stop loss only 5 points away is probably too tight and you're really likely to get stopped out by normal market noise. Using the ATR helps you place your stop loss outside the noise zone. It also helps in setting logical profit targets based on the market's current volatility. Another powerful tool is the Stochastic RSI. This indicator takes the RSI and runs a stochastic formula on it, making it much more sensitive and useful for timing entries. While it can be noisy in trending markets, it excels in ranging or sideways markets. Profitable traders combine the stochastic RSI with clear support and resistance levels. They wait for the price to hit a major support level and then look for the stochastic RSI to become oversold and cross up, confirming a potential entry. It's an excellent tool for fine-tuning your entries with precision, but only when used in the right context. Finally, and most importantly, is market structure. This isn't an indicator you add to your chart, but rather a way of reading the chart itself. An uptrend is defined by a series of higher highs and higher lows. A downtrend is a series of lower highs and lower lows. This is the foundation of all technical analysis. Profitable traders don't just blindly follow indicators. They first identify the market structure. Then, they layer on their tools. They might use EMS to confirm the trend direction identified by the structure. Use RSI divergence to spot a potential break in that structure, and use volume to confirm a breakout to a new high or low. The indicators are simply tools to confirm what the price action and structure are already telling them. Remember, indicators alone will never make you a profitable trader. Consistent profitability comes from discipline, a solid trading plan, and most importantly, strict risk management. The tools we discussed today are powerful, but they are just one piece of the puzzle. Thanks for watching. If you want more high-probability trading education, make sure to subscribe to We'll see you in the next one.